The rally on Wall Street is holding, but the real test is coming. US stocks pushed higher in recent sessions, extending a stretch of gains that has lifted major indexes over the past several weeks. Investors are feeling cautiously optimistic, but that optimism is about to run into two of the most important market events on the calendar: jobs data and corporate earnings. Start with the labor market. The upcoming employment report will give investors a fresh read on hiring, unemployment, and wage growth. Those three numbers matter more right now than almost anything else, because they directly shape what the Federal Reserve is likely to do next with interest rates. Here is the dynamic in plain terms. If hiring is strong and wages are rising fast, the Fed has less reason to cut rates. Borrowing costs stay higher for longer. That tends to weigh on stocks, especially companies that carry a lot of debt or depend on cheap financing. On the other hand, if the jobs numbers come in softer than expected, it can fuel hopes that the Fed moves sooner toward cutting rates, and markets typically like that. This is the tug-of-war investors have been navigating all year. Strong economy, stubborn inflation, a Fed that has kept rates elevated, and a stock market that keeps grinding higher anyway. The recent rally reflects a degree of resilience. When stocks climb steadily rather than sharply, it often signals that investors are confident but not reckless, watching the data, not ignoring it. Earnings season adds another layer. Corporate results show how businesses are actually holding up under the weight of high borrowing costs and mixed consumer spending. Strong profits tend to validate the rally. Disappointing ones can reverse short-term gains quickly. Investors will be paying close attention to what company executives say about the months ahead. Guidance matters as much as the headline numbers. There is one more market to watch alongside stocks: Treasury bonds. Bond yields, which move in the opposite direction of bond prices, tend to rise when jobs data comes in hot. Higher yields put pressure on parts of the stock market that are sensitive to interest rates, including technology and real estate. So a strong jobs report does not just affect stocks directly, it ripples through bonds and the dollar as well. The takeaway heading into these events is straightforward. The rally has shown real staying power, but it has not been tested yet by a major data surprise. Jobs numbers and earnings results that significantly beat or miss expectations could move stocks, bonds, and the dollar fast in either direction. Watch the labor market data closely. The Fed is watching it too, and right now, so is everyone else. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.